We tend to think of cash as merely physical currency sitting idle in a vault or a wallet. But in the financial markets, cash is an active, dynamic asset class, serving as the foundational layer where almost all investors store at least a portion of their wealth. To understand how it operates, we have to look at the first world of cash, retail cash deposits. This is the everyday banking ecosystem utilized by individuals and commercial businesses. This table breaks down primary retail accounts. Current accounts provide high liquidity, but near zero interest. Savings accounts offer better returns. Below, savings fragment based on notice periods, ranging from instant access to 90-day warnings to fixed-term accounts where money is locked up. The fundamental rule governing this retail environment is a strict trade-off. To earn a competitive interest rate on your money, you must surrender immediate access to your funds. To accurately gauge those returns, financial institutions use the annual equivalent rate, or AER. This metric calculates the true yield on an account by factoring in exactly how often the interest compounds over the year. The retail world also accommodates specialized strategies. An investor might hold foreign currency deposits to speculate on international exchange rates, or open a Sharia-compliant Islamic savings account, which operates on shared risk and ethical profit rates rather than traditional interest. But retail cash has a rigid ceiling. If the interest you earn sits below the current rate of inflation, inflation quietly erodes your purchasing power. Your balance might look stable, but your real return drops into negative territory. The primary appeal of retail accounts is their safety net. Even if a deposit-taking institution becomes insolvent, government-backed schemes, like the FDIC in the US covering up to $250,000, or the FSCS in the UK, ensure your deposits are protected. That protected convenience comes at the strict cost of capped yields and vulnerability to inflation. While the retail ecosystem works perfectly for a few $1,000s, where do massive institutions store billions to maximize their efficiency? They bypass retail banking entirely and enter the second world of cash, the money market. This is an exclusive wholesale environment designed specifically for borrowing and lending large sums for periods of a year or less. Central banks and multinational corporations rely on this market because of its immense scale, deep liquidity, and the high creditworthiness of the issuers trading there. Looking at this document, the foundational asset is the Treasury bill. Governments issue these to finance immediate borrowing. Moving up, we find repos. Functioning like secured loans, they allow holders to raise cash using securities as collateral. These instruments allow massive institutions to park billions of dollars safely overnight or for a few months. They keep the global financial system fluid while ensuring that idle corporate cash still generates a return. Corporations participate by issuing their own specialized tools. Commercial banks issue certificates of deposit for fixed-term funding, and blue-chip companies issue short-term unsecured promissory notes known as commercial paper. While retail accounts simply pay a stated interest rate, returns in the wholesale money market are calculated using two distinct pricing classes. This chart illustrates the two methods. The top half shows instruments quoted on a yield basis, paying straightforward interest. The lower half reveals discount instruments like T-bills. Sold below face value, investors profit from the difference upon maturity. The money market is a highly sophisticated, low-risk engine for yield, but because these transactions require massive minimum subscriptions, direct access is entirely blocked for everyday retail investors. This leaves the everyday investor with a significant problem, bypassing massive institutional minimums to access those wholesale yields and stability. The solution to that barrier is the money market fund. These specialized investment vehicles act as a functional bridge, connecting the retail public directly to the institutional money market. A money market fund pools smaller retail deposits from thousands of investors into a single, massive cache of capital. The fund managers then use that leverage to purchase a diversified portfolio of wholesale instruments, acquiring large blocks of T-bills, certificates of deposit, and commercial paper. Portfolio managers often use these funds tactically. When stock markets experience prolonged downturns, a money market fund provides a safe haven. Investors can take profits and park their cash, preserving capital without committing to new market risks. But utilizing that bridge requires caution. If a money market fund offers a yield significantly higher than prevailing market rates, it is a clear indicator that the fund is buying riskier, non-investment grade underlying assets to generate that return. That introduces a hidden risk. Unlike the checking and savings accounts at your local retail bank, money market funds are typically not covered by government deposit protection schemes. If the underlying wholesale assets fail, your deposit is exposed. Cash is an active strategic choice. Maximizing it means constantly balancing your need for liquidity, your desire for yield, and your tolerance for risk across two massive interconnected financial worlds.